Lars Barstad, CEO of Frontline. Thank you for sitting down with Mariel for a talk.
Well, thank you for having me. I'm looking forward to this.
We should start by doing a quick recap of the last few years. What has it been like to be an oil tanker CEO of the 2020s?
Well, it's been interesting to say the least. I came in the fall of 2020 as we were coming out of the big storage story for tankers. Global oil demand was starting to recover actually fairly quickly post COVID, at least in the Western world, and we started to see the huge amount of vessels that were storing crude oil that had no home due to demand destruction to be released. So that was basically, and I started my career with Frontline in basically not paying out the dividend as the visibility in the market looked, quite tough for the next few months until this kind of normalized. Then we came into 2021, and it was basically a recovery year, I would say. Western Europe or rather the Western world, US recovered fairly quickly from COVID. We were hang of vessels, obviously, doing the inventory or doing the storage part. But towards the fall of 2021, the world actually started to normalize. China was still outstanding, but it started to normalize a little bit. And we actually had some anticipation for 2022 because we thought this could be the normalization year. But obviously then we had what happened in Ukraine, Russian invasion, which made or created a huge amount of volatility for that year too. And more recently, I think kind of the big driver in our market, in addition to the story around Ukraine, has obviously been China finally opening up, and with the effects that has had. But it's for sure been a volatile start, and a lot of themes affecting tankers.
So one of the main key points for the oil tankers has been the aging fleet, the low order book. But then more recently, as you just mentioned, we've also seen the Russia conflict. And my next question would be, where would we be today without the Russia conflict?
Well, I think kind of the general backdrop here is the lack of investment in tankers. For people like me who's been around in this industry for quite a while, we kind of, once the financial crisis hit in 2008, 2009, 2009 for tankers, we had an enormous amount of ships on order. Everybody burnt their fingers during the coming years post that, and we had some terrible years in tankers where basically people were shunning kind of ordering any new capacity. And this has kind of been a bit sticky. And then due to the various, kind of tankers were probably the sector recovering, the latest, post-COVID. Meaning that a lot of other segments were highly sought after, and we saw kind of quite a massive ordering in container ships, LNG, LPG to some extent, even dry bulk vessels were ordered during that period. Basically, people forgetting that there is a tanker industry as well. So you could say that backdrop has been alive for a long time, where we've seen kind of an increasing underinvestment on the tanker side. Then, obviously the Russia story happened. It's had two kind of major implications. The trading patterns have been very kind of inefficient for the last 12 months. The fact that Europe doesn't really import Russian crude anymore, which is literally next door, at least the mother lode of their exports, and that oil then moving to Asia. And then Europe needing to replace that crude has created a very, very inefficient trading pattern. I think it's difficult to put a number on it, but I would at least assume 10 to 15% increase in overall ton miles for tankers. It's been somewhat more benefiting for the Aframax and Suezmax segments, the typical segments that can load in the Russian ports. Whilst it's been negative for the VLCCs, actually, which we saw last year, that they were kind of the underperforming asset class. But I think it has had another effect as well. It's kept a lot of this aging fleet alive for a longer time due to the very, very high margins you can draw out of trading Russian oil, and particularly outside of the sanctions. So it's also kind of affected the overall fleet position, a little bit, that we actually, we potentially have vessels now in the fleet that otherwise would have been recycled.
So there has also been some talk about the OPEC cuts and the effects on the oil tankers. And what are your expectations in terms of OPEC production and exports going forward?
Obviously, I don't know more than the market kind of commentators in general would argue, but I have sympathy for the argument that for OPEC, and in particular Saudi being one of the leading kind of exporters in OPEC, they're price sensitive. And I think as long as crude prices hold here between $80, $85, $90, whereas 85 seems to be kind of the target price, I don't think OPEC will cut anymore. I think it's more likely that OPEC will start to ease the cuts if we move anywhere significantly above 90. This is a voluntary cut. So I think OPEC actually has the ability to turn the tap up should it be needed. Say if we suddenly end up in a rally on crude prices, one should expect OPEC to supply more barrels. I think for tankers, these OPEC cuts have had a bit of an adverse or kind of a different effect. The biggest engine on the oil side right now, although macroeconomics is somewhat shaky, has been China. China imports are back up, pre-COVID levels, and those barrels are now being sourced from other sources, as OPEC, and particularly OPEC in the Middle East, are seem to be very compliant to the cuts.
So others in the oil tanker companies have reported that oil from the Americas seems to tick up when after the shortfall from OPEC, and I'm wondering, does this outweigh the loss of oil, and does it even improve your ton miles or more oil now seems to come from the Americas?
Yeah, I think that's a very valid point. We've seen kind of U.S. oil exports have increased or been kind of steadily very high. The effect of the OPEC cuts means that Dubai, which is a kind of a price benchmark similar to Brent and WTI, but prices oil in the Middle East, has kind of the prices increased to such a level that it's more economical to take kind of US linked barrels or even Northwest Europe linked barrels or from West Africa. Also, you have the situation that where you see significant production growth going forward is Brazil, and also a new country, kind of new entrant to the market called Guyana. And so they kind of make up the mother load of the LATAM production growth. And you also have US oil production and exports, which is extremely dynamic and price sensitive. There has been a discussion about underinvestment in American oil production or shale production, but I think it's starting to become apparent now that they are far more efficient in pulling resources out of US shale, meaning that they are actually able to surprise to the upside both on production and exports. So I think kind of that this is a part of the ton mile story, and particularly benefiting the VLCCs who do the long haul trades.
I also note that some of your competitors are forecasting quite demand growth in Asia, and this has been quite a hot topic for a long time, the global oil demand. And now I see this recent forecast, and they seem quite positive. And I'm wondering where you stand on this issue.
I must admit that I'm a little bit kind of nervous about that, because the general consensus is that oil demand will increase by approximately 2 million barrels from where we are now until the end of the year. With kind of the temperature checks we're getting from Asia, and particularly China, on their kind of inland economical situation and so forth, it's actually a little bit difficult to envisage. But kind of the key driver for oil demand, particularly in the winter months or towards the winter months, is temperature. And we had a very, very kind of warm winter last year. It's not statistically very likely that we'll have that this year too. It's not a really random walk, but it has a tendency to hit back. And also, there's kind of a huge part of not population, but oil demand is in the northern hemisphere, so either North Asia, Korea, kind of northern parts of the globe, where the winter and the temperatures affect demand quite significantly. So I believe that's basically where kind of most of this demand is expected. And since we had an untypically soft winter last year, maybe they're right.
There's been a lot of talk of underinvestment and a supply crunch in oil this decade, but when you look at other sources, you get the impression that it is quite easy to get new oil on stream, and then what is sometimes claimed. And I'm wondering what your view on this is.
Well, it's obviously we follow this kind of with a left eye. It's a Norwegian expression anyway, kind of the whole thesis for what we think we're in now is Goldman Sachs refers to it as the revenge of the old economy, underinvestment not only in tankers but in any kind of commodity part of the value chain, and also in a scenario where you want to move to low carbon fuels and whatnot, you need a lot of energy to do that, and that energy is not easily available. In addition to that, obviously you need a lot of raw materials, and this is kind of the thesis behind it, or the big kind of spiel behind it. On the oil side, yes, that has been exposed to exactly the same underinvestment as tankers have seen. One tends to talk about kind of deep water oil, which is sticky oil. That's kind of a long-term investments that needs to be made, and it's huge capital investments that has to be done to say discover or get a field to production on deep water or offshore. And obviously those are slow to move, and we've not seen kind of any indication that investments have started in that part of kind of the oil space yet. But I mentioned already the US fracking. They have technology gains, and in addition, it's fairly easy or quick to drill a well and get the field producing. Up till now, they've been extremely focused on just harvesting, so basically returning cash to their shareholders, not doing the capex that they need in order to increase production. But you're also seeing some of the same, and I think kind of what you've seen over the last couple of months with particularly in offshore rigs, and also on the construction of FPSOs, is that existing field expansion is happening. And those are kind of the low-hanging fruits. You're not developing a new oil field. You're basically kind of due to technology gains or better knowledge of things. You're better understanding of the geology or whatever it is. You're able to extract more barrels, and I think that will kind of help us going forward. So I think it's a combination of that and in fact the US markets that will be able to replace or increase production to a level where demand is going to be going forward.
Moving over to the order book. So big point in the tankers has been that the order book has been almost non-existent, but it seems it's been picking up a bit lately. From my numbers, the Aframax is up almost 14 to 14, and the Suezmax is up to 6.6, and the VLCC is about 1.1. And could you give some background about this and talk about the significance for Frontline?
I wouldn't be alarmed by kind of the small increase in order books that we've seen over the last couple of months, basically due to the fact that the aging of the fleet is actually racing ahead of whatever orders being made. Also, and one particular one for LR2s is that the real kind of efficiency loss starts at 15 years, basically due to kind of, if you're going to transport a clean refined petroleum product, you can't do it in an old coated tank. But there is another kind of thing at play here, and there is first of all a limited amount of shipyards that build tankers. There is also it's almost like a pyramid. Say if you have 300 yards at the bottom of the pyramid that can build any ship. And then you have 200 of them can build a tanker, and then 180 of those can build an Aframax, 150 can build Aframax and LR2, and then it goes up. But when you come to the VLCCs, there's actually a very limited amount of shipyards that build the VLCCs. It's a huge vessel. You need a big facility, and it's a complex construction. Historically, it's been the Koreans, Japanese, and to some extent Chinese that are catering for the VLCC market. And these yards are occupied to a larger extent building container ships, LNG carriers, and other kind of high-end technical kind of ships that yields them a better margin than building a VLCC. So I think kind of it's there are more yards, more competition, easier to build the smaller ships, and that kind of reflects how the order book is structured right now. And I think we got a kind of a good marker here today where Euronav made public that they've ordered a VLCC in China for Q3 2026 delivery. That's in 3 years' time, and that's kind of the most recent new build order we've seen. So I think that tells a tale of what the capacity is to actually replenish the tanker fleet, and particularly the VLCC fleet, which is kind of the big volume mover. So what we're facing now is basically due to some of the factors I mentioned earlier, with ships being engaged in ordering other or building other types of vessels. You now are in a situation where the delivery window, even if we were to go gung-ho out and ordering vessels right now, the delivery window is so far out, and we have visibility, but we rarely have that long visibility in the tanker market. It makes people very uneasy to order vessels that far out.
Moving over to the Frontline Euronav merger attempt, could you sum it up a bit, and what are the main conclusions from it? What can we expect from Frontline and the industry in terms of M&A going forward?
As you probably can imagine, I've had this question 1,000 times. So it was we believe it was a great attempt for basically to achieve a large commercial kind of position, also to further build on the synergies the two companies have, kind of standing to be one unit. We always struggle in the tanker market that you know, there are too many owners, too many smaller owners. That it's too fragmented. You know, it's you know, kind of the buy side. You know, the ones transporting oil. That's a fairly kind of homogeneous mass of big companies, whilst on the owning side, you know, there are hundreds of small and medium-sized owners. And you know, to achieve something in this market and to become more efficient, and also to face kind of the regulatory framework going forward and so forth, being a big unit, you know, is an advantage. Regretfully, that merger attempt was blocked by one shareholder buying up to 25%, and that blocking position, you know, made it impossible to go through the merger. I think, you know, consolidation is always on everybody's mind, but M&A activity is very challenging in the tanker industry. Most of the listed tanker owners have a very strong owner. And as we know, strong owners, they want to run their own business. And if they don't want to run their own business, they want a competitive price on the assets if they're going to sell their business. And this kind of creates, you know, a situation where even though the share price might be priced as a discount to the assets the company owns, it's very rarely you're able to actually get anywhere kind of, you know, in that process, to put it that way. I think we, you know, right now we're a bit kind of sitting on the sidelines, you know, watching and looking at how this market develops. Frontline will always be opportunistic and look for opportunities in the market, but I don't think I can kind of comment beyond that.
There was some reference to minority shareholder resistance, and could you elaborate a bit on the reasons for that and if it was justified?
What respect with the Euronav transaction, or?
Yes.
Yeah. So basically, in order to perform, you know, a merger, you know, and you know, to get through the you know, to do it on the regulatory path, you need to have more than 75% support in the company. And you know, that is not possible when one shareholder holds 25% of the shares, and that means that you can never kind of create an efficient merged company. You know, you would have to run with two kind of separate units, and that's not an efficient way of running a company, kind of. So it's basically like, you know, somebody put, you know, it's as you've seen other companies have poison pills or other structures in the governance in order to prevent kind of you know, shareholders to actually get to power. This was another maneuver that created the same.
I see that Frontline is among the companies that trade at a premium to NAV, and I'm wondering, is this an expression of confidence, or how should we interpret this?
I think it's a sum of a few factors. Number one, you know, we have kind of on a relative basis slightly higher leverage than peers, which obviously means that you know, there's kind of less equity to receive dividends. So you get kind of a, you know, higher relative yield, or whatever you however you frame it. Secondly, you know, we do run a very, very transparent tanker company. It's very easy to calculate, you know, from kind of the achieved time charter rates, you know, deduct the cost, and you see the bottom line. It's actually very few companies that you can analyze in our industry, stock listed ones, that have the same level of transparency. And also with the lean kind of cost effective organization, we do tend to create a bit more bang for the buck. So I think it's related to that, and also obviously that we have a very strong shareholder who, you know, he thinks like an investor. You know, he's probably one of the most kind of demanding shareholders one can have. always kind of focused on the fact that we should always have the shareholders' interests at the top of our minds. And I think that kind of creates this halo effect that kind of means investors will very quickly go to Frontline. If you have more demand for your shares than what's at offer at any point in time, you do get a better pricing. Cash flow yield, if you put that into a model, I think most analysts realize that you get a bit more in Frontline than in many of our competitors.
Moving back to the fleet and fleet composition, we already touched a bit upon it, but could you just talk briefly about your fleet composition and what kind of scenario which benefits you the most?
I think kind of, we're a bit of a, we stand on 3 or potentially 4 legs. The Afra and LR2 leg, as as the market or people should be aware, Aframaxes and LR2s is in fact the same ship. All our LR2s or Aframaxes are coated, meaning that they can switch between the 2 trades. This kind of asset class, it's in fact the VLCC of the refined product market. They benefit from the fact that the refinery capacity has been reduced over the years in North America and in Europe, whilst the refining capacity has increased tremendously in the Middle East and in Asia in general, and particularly China. And with that, you create a longer distance from key demand centers to key refining centers. So this, is kind of a, ton-mile story, happening literally as we speak. So basically creates a, demand for the bigger kind of long-haul carrying product vessels. Then you have the Suezmax, which is a versatile asset class. We've always kind of had that as a part of our fleets. It's kind of the workhorse of the oil market. The Aframax market is also a fairly small fleet relative to the other asset classes. It's also actually had the advantage of a low order book for quite a while. And then, we have the big kind of ocean-going VLCCs, which I believe kind of, obviously historically it's been the asset class that Frontline is always kind of put emphasis on. But I think it's economies of scale actually work in oil trading, which actually plays a part on the tanker side as well. And on the VLCC, you can fit 2 million barrels of crude oil versus 1 million barrel on the Suezmax side. And that actually has a great deal of value to the oil traders. Competition is fierce in the movement of oil between various regions. And then obviously, if you can fit more oil to a relatively kind of smaller price, you'd obviously do that. And for the owner, namely us, it doesn't really make much of a difference. The cash break even between the cash break even spread between the Suezmax and the VLCC is only $45,000 per day, meaning and obviously the potential upside for a V historically is 3 times that on the VLCCs. So it basically is logical that we kind of favor that asset class.
When I look at recent data, it looks like the VLCCs has been holding up the best. And is this something that will last?
Well, it depends. It's I think that is more a result of the OPEC policies and their cuts, and in particular in the Middle East, as we discussed lately or last kind of earlier, with a lot of kind of oil coming from the Atlantic Basin going to Asia, which is a long haul trade. VLCC is also the asset class that has the least kind of order book, and there are literally no ships going to be delivered for the next couple of years. and it has a very kind of average age of the fleet is getting higher. Almost 13% of the fleet is above 20 years already, meaning it's effectively excluded from the market. So yes, I think kind of VLCC has a lots kind of going for it, and I think kind of the recent what we've seen recently on Russia and the fact that the price cap has actually started to come into play means that Russian exports are come off and Russian oil is less available to Asia. I think that also benefits the VLCC. So I believe I think the weakness on the Vs that we saw last summer is probably what's atypical and kind of out of the ordinary. I think the current strength we have on the VLCCs is probably called for.
Moving on to spot rates and long-term contracts, Frontline has historically been mostly on the spot side, and I'm wondering, when is it time to start securing the good rates rather than prioritizing spot?
Well, we basically the value proposition that we have to our shareholders is to try and give them the market return. So basically, when they invest in Frontline, it's indirectly investing in tankers, and then you need to stay spot exposed in order to give them the return they expect. But we will from time to time increase our time charter coverage. We do believe that what coincides with the range of the old economy is also kind of inflation, and we are in an inflationary environment right now, but we haven't seen inflation in freight rates just yet. So if for some asset classes, yes, but not kind of in the long term. So we believe that yes, of course, we will take advantage of the time charter market when the time is ripe. We don't think we're there just yet. We're looking for kind of return on the equity, and when we do our calculations, in order to have a significant or kind of you can't go do a time charter and have 6 to 12% return on your asset. You need more than that. So we will kind of continue to increase our time charter cover, but we've only done so on the LR2 Aframaxes so far because we haven't seen kind of the rates that we believe you need in order to defend it.
You've said earlier that you expect 2 years of strong rates. Is that a bit on the cautious side, and how strong is the downside protection?
No, I know I've said 2 years. I'm kind of secretly thinking 3 to 5 years, to be quite honest, because right now the order book, where you can actually get ships delivered, if you were to start ordering now, is somewhere between 2.5 and 3 years out, depending on the asset class. So it means that we know exactly what we have in front of us for that period. But in order to start ordering a lot of vessels, in order to keep the tanker fleet just at the level it is now, so the capacity to transport at the level it is now, we need a far greater order book. So if this continues with a muted ordering, and that's also a result of the markets kind of not, the markets have been firm, they have been strong, but you haven't really had this kind of insane market just yet, and that, I believe that's what's going to trigger, when people actually feel that we have potentially a capacity issue on transport of oil, just like you felt it on the containers post-COVID. That's when people kind of start to get their pens out and start to sign new building contracts. But the further we delay this, the longer I believe this cycle can last.
And at what point would Frontline consider buying more ships?
we look at potential projects, maybe not every day, but at least once a week. There are ships, secondhand ships that will always be marketed in the market. On the new build side, we are not really looking at that. For us, it's too expensive. Well, it might not be expensive if you apply kind of we've had inflation for the last 10, 20 years. But then again, we haven't really seen that proven in the freight rates yet. So when we look at the prices for a new build right now, and the fact that you won't get it until 2.5, 3 years time, we just can't defend the risk reward of doing that. So that's kind of out of the question, at least now for us. But we are always looking at the second-hand market and seeing whether if there is an opportunity there.
Could you give an update on the refinery situation and explain a bit the relevance of Frontline and the crude tanker fleet in general?
Well, there are a few. I already mentioned kind of the dislocation between refining capacity and certain demand centers, which is evolving. We actually have a huge refinery capacity or overcapacity in the world, and there the modern efficient refineries are out competing the older ones, and I see kind of this trend continuing. The growth of refining capacity in Middle East is actually beneficial to ton miles, basically because it takes away crude oil that would go from the Middle East, which is really near Asia, where the growth is happening or incremental growth is happening, and that needs to be replaced with crude oil from other parts of the world. You have the same story going on in Nigeria, where they have one of these huge refineries that is in construction and is expected to come online over the next, it's actually been expected to come online for the last 7 years or something, but say it does come online. This is a 450,000 barrel per day capacity refinery, and people are saying, well, that's going to take away a lot of crude freight demand. Well, not necessarily, because it's also going to take away a lot of crude that would be exported to Europe and China, and that needs to be replaced then. So basically, kind of as this evolves, the kind of this refinery build-up story has a tendency to have this adverse kind of reaction on crude as well. We basically, when we analyze it, we see that this is kind of going in parallel, and at the end of the day, the refining capacity is being built up to basically due to the fact that the demand for refined products is continuing to increase. Kind of the big headline which people seem to forget is that oil demand and refined products demand has a tendency to grow with population. Population growth is around 1.5 to 2% per year, and also you need to add to that basically large parts of the population coming out of poverty, which has been a kind of a big theme both in India and China, and that gives you incremental demand. So I think kind of this is all a part of a larger backdrop that oil is potentially going to stay being one of the main sources of energy for a bit longer than people might think.
There's been some talk of increased risks of hijacking and pirates, and there was talk of I think it was a Russian crude tanker that was attacked by a drone. And how relevant is this for Frontline, and will you manage to get paid if there is more risk?
No, it's hugely relevant, and it's one of the kind of everyday issues that we face. There's kind of political unrest wherever it's in the world, increases the risk for our seafarers. We have kind of the piracy. I wouldn't say piracy has slowed down, but I think it's normalized in a manner that you start to live with it. And luckily, knock on wood, we haven't been kind of in a situation for a while now where this has been this has come up. With regards to what happened in the Black Sea with the supposedly Ukraine kind of drone boat that hit a Russian tanker. This obviously increased the risk premium to go into Black Sea. We're actually, as a company, we try to stay away. We don't really want to take that risk on behalf of our shareholders for sanctions purposes and on behalf of our seafarers for that sake. So, but it is kind of complicating the picture somewhat. Are we able to achieve kind of a premium on that? I wouldn't say that. I think kind of the piracy risk and other risks, war risk in certain parts of the world as well, has become kind of a part of shipping and tankers in the industry in general. So obviously you have insurance against these things, and also sometimes the added cost of security guards and so forth is covered by the charter, but it's almost become like a normalized state rather than something new.
Moving over to the last question today, I see that some commentator and strategists such as Sultan Posar and Credit Suisse, that they pointed out tankers as one of the main winners of the fragmenting world we are currently living in the 2020s. And on the other side, there are indications that this transition into a more multipolar world might not be so smooth. So I'm wondering how you see your company. Do you agree with this statement that you will be a winner, or how do you see your company navigating through this decade, this time we're in?
Yeah, I hadn't actually seen that before you mentioned it today, but yeah, I think kind of what we've seen already due to the Russian conflict in Ukraine or Russia's invasion of Ukraine is a part of this polarization between superpowers, to put it that way, and that has created ineffective or inefficient trading patterns. We actually had like a mind game in the office today. So what happens if China invades Taiwan? How will that play out then? China needs anywhere between 9 and 9.5 million barrels per day of crude oil just to maintain kind of this, the consumption they have now. They produce a bit over 3 million barrels themselves. So they would need friends, and then those friends wouldn't be friends of, say, other countries and so forth. It would create an increased polarization of the trading environment. Basically what happened is we've seen some of this before. We've seen the sanctions against Iran has created kind of a shadow fleet, a significant amount of vessels. Probably 10% of the VLCC and Suezmax fleet is one way or another completely isolated from the compliant tanker market and trading in Venezuelan and Iranian crude. I think we're seeing some of the same developing now with Russian oil reaching the price cap, is that you have kind of Russian trading ships that also will be completely out of the conventional fleet, basically because they're engaged in sanction breaking activities. If you add to this, so basically what you get in the end is inefficient trading patterns and inefficient ways of transporting energy, and that ultimately may as for instance with the Russian-Ukraine conflict benefits ship owners.
That sums up this interview. Lars Barstad, thank you for an excellent update and best of luck with your company going forward.
Thank you very much for giving me the time, and yeah, it's exciting times, and I'm looking forward to it.